Get ready for a game-changer in Bangladesh's digital finance landscape. The Bangladesh Bank has unveiled a bold plan to revolutionize mobile money services, opening doors for non-bank players to enter the market. But here's where it gets controversial. The central bank is proposing a new regulatory framework that could shake up the industry. The draft rules, titled Regulations for E-Money Issuers in Bangladesh, aim to create a level playing field for both banks and independent digital finance companies. Under this new structure, these entities will be authorized to issue e-money with the central bank's approval, breaking away from the traditional bank-led model. And this is the part most people miss. Existing mobile financial service, MFS, and payment service providers, PSPs, will need to reapply for licenses within 6 months of the regulations taking effect. That's right, even the big names like bKash, Rocket, and Nagad will have to adapt to the new rules. The Bangladesh Bank is taking a proactive approach to bring these digital transactions and payment services under a formal legal and supervisory structure. Why? To ensure institutional stability, financial security, and, most importantly, consumer protection. According to the draft, the new rules are designed to promote financial inclusion, ensure the safety and reliability of e-money, and foster a competitive and innovation-driven payments environment. It's a tall order, but the bank is confident it can achieve these goals. A senior official, speaking anonymously, described the draft as a milestone reform. He emphasized the goal of creating a safe, inclusive, and technology-neutral framework that encourages competition and innovation. We want both banks and fintechs to expand financial access, he said. Industry leaders are buzzing with excitement. A leading fintech executive praised the move, saying, allowing non-bank MEs could accelerate innovation and partnerships in mobile and online payments. So, what do these draft rules entail? The framework introduces 2 categories of e-money issuers: authorized MEs, which include regulated institutions like banks and finance companies, and dedicated MEs, DEMIs, which are non-bank entities focused solely on e-money and related payment activities. Applicants, especially DEMIs, must meet certain criteria. They need to maintain a minimum paid-up capital of TK 50 crore, submit a 3-year business and risk plan, ensure proper governance, and establish trust and settlement accounts to protect customer funds. Additionally, they must implement robust risk management, maintain secure technology systems, employ multi-factor authentication for high-value transactions, and continuously detect and prevent fraud and cyber threats. Effective governance is key. E-money issuers must have directors of high integrity, strict segregation of duties, and mandatory board audit and risk committees to ensure internal controls and regulatory oversight. Violations of these rules could result in hefty fines, license revocation, and even legal action. The Bangladesh Bank is inviting stakeholders to provide feedback before the final regulations are issued. Once implemented, this new framework is expected to transform the country's digital finance industry, bringing it in line with international practices seen in countries like China, India, and Malaysia. With the Bangladesh Bank exercising oversight and supervisory powers, the future of digital finance in the country looks promising. But what do you think? Is this a step in the right direction for Bangladesh's financial sector? We'd love to hear your thoughts in the comments.